So interest rates are trending downwards. I do not have a crystal ball. So I've been on this roller coaster with the rest of you. It has been a relief to see rates begin to come down. You could get into a 3 or even a 4 unit property with a 3.5% down payment, and often some other clothing cost discounts that might come with an FHA loan. A renovation loan allows you to, in the purchase transaction, to finance the renovation. So you're now putting a down payment on the sum of those two costs rather than just a purchase price.
Hey guys, my name is Sharad. I'm the owner and founder of REsimpli. Also active investor in Northwest Indiana, right outside of Chicago. Flip about 25, 30 houses a year, and also own some rental properties and property management business. We do these weekly calls, bring on an industry expert to kind of share, their expertise, what's going on in their world, and how it can add value to real estate investors. So today we have Nate. Nate is an absolutely an amazing lender. He helped me with my personal residence when Wells Fargo had completely dropped the ball. He came in and helped me close the loan in like under 3 weeks. So Nate, thank you so much for that. Super excited to have you on the call. If you want to give a little bit background, and then we can jump right into the Q&A session.
Absolutely. So as Sharad mentioned, I'm a residential lender, and working with investors has been a niche of mine, although I work with just about anybody and everybody. Beginning probably 5 or so years ago, I stumbled onto an investor that was just kind of starting out, building their portfolio, and we kind of learned quite a bit together in helping them, purchase the first couple of properties and growing that into a much larger portfolio as it is today, and expanding that into other clients. And by ways of that, I've come to meet Sharad as well. But it's a passion of mine, helping people grow wealth through growing their portfolios, and teaching a little bit of know-how in that realm, because it is important, and I can't stress this enough, having a team that understands what your plans are and what you're trying to do, not just a loan officer, but also a CPA. We'll talk more about some of that stuff here in a bit. But I'm happy to be here. I'm happy to be back.
Yeah, thank you, Nate. Nate, first of all, the first question I have right off the bat is the interest rate has been super high. It's starting to come down. Like, where do you see the interest rate going from here, and how should investors kind of factor that in? Is that something they should be like, hey, I'm buying based on the interest rate right now, or they should like wait, maybe another month or two before the interest rates come down a little bit more?
Well, good question. So interest rates are trending downwards. I'm going to preface this with, I do not have a crystal ball. So I've been on this roller coaster with the rest of you throughout the last couple of years. But it has been a relief to see rates begin to come down. I believe that started last month. The jobs numbers actually started a bit of a descent, and then the kind of foregone conclusion that there will be a Fed cut in September has kind of pushed that down even further, pushing bond prices up. That said, will we see a big change later this month when the rate is presumably cut? Not entirely sure if we may have already baked that into the pie, seeing that what happened to the bond market, seeing what happened to interest rates, some of that, I expect to see some movement regardless, because we are on this downward slope, and we intend to be on this downward slope. Across the industry, economists agree about the future. The discrepancy is in what that timeline looks like. I know NAR had an estimate at a forecast over the next couple of years. The Mortgage Bankers Association had another forecast, their economist, and across the board, they're saying the same thing, just differences of opinion on how steep that slope might be. For investors, though, it's all about your cash flow. And that's what matters at the end of the day. So what I'm telling my clients is I'm not recommending that they purchase many points. We're trying to keep the cost down because there's a very real possibility that they'll have the opportunity to refinance in the not so distant future, whether that be 1 year, whether that be 3 years. You may not reap the benefits of investing heavily in purchasing down a rate. But if the cash flow makes sense, I don't care what the rate is. If you have the opportunity to make the funds that you need to, and that's something, again, in the planning stage, knowing what you want to make, knowing what that margin needs to be, and you can analyze it regardless of what the rate is. Analyze the situation, see if you meet that margin, and like I said, keep costs down because in the future you will have the opportunity to refinance. And I think that will be, in my personal opinion, I think that's going to be the not so distant future.
At what point does it make sense to refinance? Let's say, if my mortgage rate is 6%, and right now I can refi at 5.5%, for example. I'm just making this up. But then there's an anticipation. I mean, there's of course cost involved with refinancing, and there's an anticipation that interest rate may come down again, and they may continue to come down. So, like, at what point does it make sense to just pull the trigger, or just keep waiting for another, few months before they stabilize a little bit? Any insight on that?
What I would say is I'd like to see, and what I recommend is closer to a 1% drop in your interest rate to kind of justify those costs. It's also going to depend on the size of the loan, because smaller homes that you purchase, maybe renovated, and you're looking at a refinance, if the costs are going to be those costs are going to be a much larger percentage than maybe your primary home that may have a larger value, and those closing costs make a little bit more sense given what you'll be saving on a monthly basis. But across the board, I'd like to see closer to a 1% drop in rate to really make that investment make sense. And you just can't, as much as you may want to, you can't return to that well every time you see an article that says, there's an attractive interest rate out there, because you do need to make back some of that investment, that barrier to entry that is those closing costs. So that said, I'm curious to see where we are after this election cycle. We do have a little bit of respite now where we've dropped significantly in the last 30 days. So I'm seeing a lot of activity around refinancing some of the interest rates that have been in the mid to high sevens. They've now reached, or even in the low sevens, they've now reached that point of having that 1% drop in rate where they could stand to benefit. But I would personally, I would be optimistic about where we may land when we see calmer waters after this election.
And what do you see in the market right now that's working for investors? Is it a particular product that's working? Is it a particular market that's working better than others for investors out there?
Middle American markets are really seem to be have been a winner for my investors. Finding small markets that have a lot of room for upward growth. We have some growing populations in Middle American cities. I'm a little biased. I'm here in Columbus, Ohio, which is a growing market in and of itself. But that said, those markets are where you're seeing lower annual taxes. You're seeing a lot of growth in the value there. I see the mass majority of my investors flocking toward towns like that, as opposed to, historically where the investment has been in more coastal cities and things like that, thought of as vacation spot.
And what sort of interest rate are investors getting right now on their loans? these are 30-year fixed, what sort of interest rate they can expect to get? I know there's like several variables, but just on average.
Absolutely. So investment properties are going to have higher interest rates than your primary mortgages. So just across the board, there's three categories that they will fall in. You either have your primary home, your vacation home, secondary home, or everything else is considered an investment. Even a home you purchase for, your sibling is considered an investment property if it doesn't fit any of those other two categories. And that category of homes is going to have a much higher interest rate than a primary home. So when you see, for instance, Freddie Mac releasing last week that um, the average 30-year mortgage was about 6.35%. That was just this past Friday. Investment properties are going to be about maybe a half to 5/8% above that. So I put that at about 6.875 for an investment purchase right now.
Got it. And then for someone to purchase an investment property, is there any way to get around like putting 20% down, or that's absolutely like requirement that they have to put 20% down for an investment property?
The minimum for a single family investment property is actually 15%. And that doesn't get talked about very much. That is an option. It lessens the amount of cash out of pocket, but you will see a greater amount of either a greater interest rate or a greater amount of points due at closing, coming with putting that 15% down as opposed to 20 or 25% down. So it is an option. I typically will work through that with the client, kind of showing the three different options: higher cost, less down payment, versus a greater down payment, lesser cost. But that sort of initial investment of a minimum of 15% is going to be necessary for all residential mortgages. And it is a bit greater for multi-unit properties. It jumps to 25% for multi-unit properties.
Multi-units would be more than 4 units, right? 5 or above,
Even
or
even
2.
2 units, 2 and
Okay.
greater.
Okay, 2 or greater. And then with 15%, are they paying PMI, private mortgage insurance, or
Yeah.
they are? Okay,
Now there's a couple of ways to do that. You can do a single finance payment at closing. We can actually talk through whether it makes more sense to do a monthly or a single pay. But that's part of those greater costs that come with the smaller down payment that we would talk through.
got it. And then is there any way to get around, like an investor or an individual can get up to 10 loans, including their primary residence, correct? Is there any way? I know an investor friend of mine, he's purchased 20 properties, 10 in his name and 10 in his spouse's name. But
Mhm.
is there any way to get around that? I mean, when he's buying more, he's just paying off one of the smallest loans and then getting a bigger loan. Any thoughts on that?
That is exactly one of the strategies is kind of splitting them up and having some title in your spouse's name, things of that nature. The rule is 10 financed properties. It is a maximum for conventional mortgages. In that instance, I see a lot of investors who may, by the time they get to that 10th property, they may have the opportunity to refinance some, reposition some of those smaller debts to consolidate